All right, what is up, traders? What's up, tycoons? Super excited for today's video. We've got a jam-packed one full of lots of data that you're really not going to find anywhere else. And there's some big warning signs that the market is telling us. Now, whether it's the number of stocks making new highs versus lows, whether it's a defensive rotation in high beta, discretionary staples, credit spreads, and biotech, whether it's the relationship between credit spreads and stocks, okay, such as these two slides, or the relationship between the dollar and the stock market potentially setting up for a rug pull. Also seasonality, right? We'll take a look at some different seasonality factors here. We'll break down the market internals from last week and show you guys some of the warning signs there. All right. But it's not all terrible, right? And, there's a few things that are still sticking out that are more bullish, right? The market is still risk on at the moment. We need to see that continue to make higher highs. We can't necessarily be bearish on the entire market when these four are above their 2021 highs. When these four are above their 2021 highs, all of this is bullish, right? And is why we've been seeing these all-time highs. But it doesn't mean that we have room to pull back for higher lows. Yes, it does, right? And if we were to get those higher lows, we can still be bullish, right? But we're seeing a lot of warning signs in the market suggesting that we could pull back, whether it's in the relationship between treasury yields as well in the stock market. We'll take a look at smart money versus dumb money. We'll take a look at, TLT often is a leading indicator for the market. So we'll break down the warning signs that we're seeing across TLT and the S&P 500. We'll take a look at the relationship between the Mag 7 and the other 493 stocks in the market, right? And then we'll take a look at the skew as well. The skew is also flashing some warning signs to us here also. So jam-packed video, lots of data. You're really going to want to stay through to the end so that way you don't miss any of the great content. And we'll go ahead and get into it. All right, we're also going to take a look at, I forgot about this one. We have the percentage of stocks above their moving averages. All right, that's another one there showing some warning signs. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. If you're new to the channel, I started a completely free newsletter giving out free valuable finance content, free trading content, and I try to sprinkle in 1 to 2 free trade ideas. This is what the trade ideas will look like, highlighting the conditions on the chart, showing you guys the chart. And you can take a look at the website and see that many of the newsletter trade ideas have worked out very well. And the reason being is because I prefer quality over quantity. So I'm not spamming your inbox every single day with 5 to 10 different trade ideas, trying to brag about one that works, but rather identify high quality setups, show you guys those high quality setups. And through that process, maybe you can learn how to identify your own high quality setups as well. RTX was one of the recent newsletter trade ideas. You can see, people talking about it in the Discord saying that it went up over 88% for them. And if you want to join the Discord, it's only $10 right now. So you can get in for $10 a month, less than a cup of coffee a week. And these are some screenshots from the past week or two from, people in the Discord. See people in many different plays, hitting over 100%, people making thousands of dollars in a day. All right, very, very nice group. And that's where you get all my analysis and all my trade ideas rather than just 1 or 2 a week from the newsletter. You'll get over 20 different swing trade ideas every single week in the Discord. On top of valuable resources as well, custom scripts, indicators, being able to see gamma levels, dark pool levels for stocks that you want to look at, many different things. So let's get into it. And let's start off here with the highs versus lows. So this is the number of stocks making new highs versus new lows. And what we see is a bearish divergence at the moment. Now, question, right? Maybe you have a little question here. What is bearish divergence? Okay, right? Well, we've got these divergences highlighted for you here. So we have the S&P 500 down here on the bottom, and we've got our highs and lows up here. Okay, and so notice how this period here where the stock market is making higher lows, right? We have low, higher low, higher low. And then here on the number of stocks making highs and lows, we have lows, lower lows, lower lows, lower lows. So in this case, this is a bearish divergence because the stock market is doing one thing, but our indicator here in our oscillator is doing something different. Okay, and in this case, it's a negative divergence. And what do we see? Well, we actually see that the stock market actually does pull back in this time period. And then we create another divergence. And in this case, it's actually a bullish divergence or a positive divergence where we have a low and then we make a higher low. But here we have a low and then we make a lower low. So the stock market's doing one thing, it's making lower lows, but we have a positive divergence here. And sure enough, what do you see? Well, you start to see the stock market rally through this period. So these divergences, they don't always play out in your favor, but oftentimes they can be leading indicators of potential moves to come. Okay. If you even take a look at one of the most recent ones where we have lows, right? And then we're making higher lows, bullish throughout this time period. And then we had a low, we had a lower low here. You see that the stock market actually had a pretty big correction. Now, it was only a 2-week correction, so it wasn't like it was super long. But again, this is another one of those things that was telling you, hey, maybe there's a little bit of warning signs here that you want to be cautious of. And if we take a look most recently, right, we've made higher highs here and we've made lower highs on our chart, on our oscillator. So these divergences can last for long times. They can last for short periods of times, as you saw here and here, short times, and here, very long time before they play out. But it's definitely a warning sign that you want to be, paying attention to, right? Basically, as the stock market's making new all-time highs and continuing to make higher highs, we're seeing the number of stocks making new highs is actually decreasing, right? And it's going down here. So, that's basically warning sign number one that, hey, we could be setting up for potential pullback or correction, right? And so you just want to be prepared for these. These aren't signs saying that, hey, you need to short the crap out of the market, the stock market's going to zero, but rather, hey, be more decisive, be more specific, and don't just long everything recklessly right now, as there's lots of warning signs. Another one right here, this is a really great chart. So what we've got in, the cyan blue color right here is going to be the performance ratio of high beta stocks versus low volatility stocks. So when this goes up, it means high beta stocks are outperforming low volatility stocks. And when it goes down like this, it means that high beta stocks are underperforming low volatility stocks. And what do we see? We see higher highs here. We see lower highs here. So we're seeing a bearish divergence on the ratio of high beta to low volatility stocks. We're seeing a bearish divergence here again, where we're making lower highs on the ratio of discretionary versus staples. So you have consumer discretionaries versus consumer staples. Consumer discretionary outperforming consumer staples means that this line is going up. That's generally bullish for the market. We have credit spreads right here as well. So credit spreads you want to see moving in the same direction as the stock market. And typically that's what you see, and you have a nice confluence. And what did we do? Well, we actually rolled over last week. Okay, so last week we rolled over in credit spreads. Meanwhile, we're still continuing to make highs. So we've got 3 bearish divergences, and the 4th bearish divergence here is going to be in biotech. Biotech is arguably one of the most risk-on asset classes because oftentimes biotech companies are profitless companies that don't generate a profit, that spend lots of money and burn through lots of money doing R&D and different research and development, trying to manufacture some type of drug or product that eventually will send the company into large profits. But until then, while they're developing those, they have to just raise a lot of money and, burn a lot of that money, and they're not really profitable. So whenever you see those outperforming, that's very bullish for the market because it means that the market's pretty risk on because they're willing to put money in companies that are profitless. Is basically why this one is on the chart. So 4 out of 4 right here are also getting bearish divergences. Okay. So, again, another little bit of a warning sign here that, hey, even though the stock market's continuing to make new highs, we are a little bit more defensive when we peel back under the hood and take a look under the hood in the high beta discretionary to staples, credit spreads, and biotech aspects. Now, to dive into credit spreads a little bit more, and I've dropped videos on credit spreads, all right? We're not talking about options right here. We're talking about credit spreads in the form of bonds and the bond market. And, what we're looking at here are the S&P 500 on the top, and then we have our credit spread ratio. This one is IEF LQD on the bottom. And typically, to justify a move in the stock market, you want to see these moving opposite of each other, right? So you see our credit spread ratio chart is moving up here. That means the stock market should be moving down, and it is. So it makes sense to us, right? And when we see the stock market going up, we want to see our credit spread ratio going down. So as we see this going down, we feel good about this rally in the market. Okay, here we were a little confused because both of these were going up at the same time. So we knew that one of them was giving a false signal. And what do we see? Well, we actually see that credit spreads start to fall here. All right, and this is a good sign for the stock market to continue its rally to the upside. And so these two should perform opposite of each other, and that makes you feel good about the movement in the S&P 500. There's no divergences. Well, if we take a look recently at what we've seen, and we break it down a little bit more, it's not like we've seen a major divergence, okay? Because technically this is still in a downtrend and this is still in an uptrend. But what I want to point out to you guys is we do have, basically we have not made lower lows. Okay, we haven't made lower lows on here, but on the S&P 500, what have we done? Well, we've continued to make highs, higher highs, higher highs, and higher highs. So, we really wanted to be seeing this IEF LQD chart continuing to break down and continue to make lower lows. So that also is a warning signal here that, hey, we're not really seeing that confluence when it comes into credit spreads. And in this one, we have HYG IEI, and then we've got the S&P 500 on the top. And we just kind of highlight all the divergences here as well, and how the HYG IEI chart can sometimes be a leading indicator for the stock market, right? Where we're seeing the stock market make higher lows here, but we're seeing lower lows on the HYG IEI. So that's a negative divergence, a bearish divergence, and it indicates the stock market could potentially pull back. And what do we see right now? Well, we see the beginning of a divergence. We see that we were making higher highs and we were making higher highs here. But again, this just rolled over and it started going down while the stock market has continued to go up. So, for this rally to continue going higher and us feel comfortable about it, we really want to see our credit spread chart here with the HYG IEI start to continue to make higher highs. So we want to see this continue to make higher highs, and we want to see this actually make a new lower low to feel good and feel like the market rally is justified, but we're not seeing that, right? So again, these are just some of the warning signs that are potentially foreshadowing a market pullback. Okay, nothing huge, nothing crazy saying that like, we've got to tank and go down to zero. But when you look at all of these things together under the hood, we are seeing lots of warning signs, not just one or two. Even right here, when we take a look at the S&P 500 on the top and the dollar, these two typically move opposite of each other, right? And we've highlighted it very well right here, where it's no coincidence that the stock market bottom around 3,500 was also the top on the Dixie, the US dollar index. Okay. Those were the exact same dates that one topped out and one bottomed out. And you see that they move opposite of each other, right? So when the stock market's going up, you see that the Dixie is moving down. When the stock market started to pull back, Dixie started to go up. And what we've got here is this period since the year has started, really, since 2023 has started, we've seen the dollar continue to rise, and we've also seen the stock market continue to rise. And is that setting up for a potential rug pull, right? And what do I mean by that? Well, the last time that we saw the dollar rising with stocks rising, we ended up getting a rug pull over here where we had a pretty significant drop here in the stock market. Okay. So that's something that you guys want to look out for. Okay. Now, again, these are all things just meant to be a little bit of leading indicators and warning signs, not necessarily guarantees. So all of these divergences that we can have, they can converge back. Okay. And what that means is that they can, correct themselves and get out of divergence from each other. But at the moment, we're seeing lots of these signals, right? Now, this is a seasonality. This is my seasonality graph that I've got on Thinkorswim. And so this is the current performance. This is the current year. Okay. And what do we see? Well, we see that we typically top out here in February, in the beginning of February, and then we start to get a pullback into March. Okay. And we continue to fall into March. And so right now we're following pretty well, right? We make a high, we make a higher high. All right, before February, that's what we're doing. And then in the, beginning-ish of February, we start to see that pullback. So, could that potentially happen? Yeah, that could potentially happen to the market, right? And then if you take a look at election year seasonality, so to get a little bit even more specific, the green line is going to be the sitting president running. So this is an election year where the sitting president is running. So that's Biden. And we see 2024 performance is going to be in this pinkish color right here. And the green line is the one we want to focus on. And what do we see? Well, we see we continue to rally into early February. And then closer towards the middle of February, we start to top out and we see a pullback back into March. So, let's take a look at just February performance here. And what do we see? Well, we see very similar things. We see that we tend to rally a little bit heading into the beginning of February, and then towards the end of February, we start that pullback. So If we're going off of seasonality, we know that typically we find some type of a short-term top in February, and we typically start to pull back in February. And then we combine what we're seeing underneath the hood, and we're seeing a little bit of defensive rotation. We're seeing bearish divergences across many different indicators or oscillators, the highs and lows, the discretionary versus staples, high beta versus low volatility stocks, different measurements of market breadth. We're seeing that across the dollar. We're seeing all of these divergences. And then we're also seeing that, if we were to get a pullback or some type of correction, it does align with seasonality pretty well. And when we take a look at the market internals, what I want to highlight here is really going to be on the tick here, all right, the cumulative tick. And so let's break these down, right? So these lines are going to be different days of last week, right? All of these vertical lines are going to be separating the days. Okay, now this was Powell's rug pull. And so you can see the VOLD, this is your volume up down, went to extreme bearish territory. All right. We see that the ad, this is the advanced decline right here, also went into extreme bearish territory on Wednesday. And then this is Wednesday trading hours. All right. And you can see that the stock market also had a very significant drop. Now, what do we see here on the cumulative build for the tick? Well, we see the very same exact thing. And then what happened on Thursday? Well, we actually saw a tremendous rally, a really, really insane rally on Thursday, right? And we were in bullish territory on the internals on Thursday, bullish internals on the internals here on Thursday. And the cumulative build was extremely bullish on Thursday as well. But look at what happened on Friday. Friday, we actually had a massive rally. Okay. But what is worrisome to me was that the VOLD was actually in negative territory the whole time. It wasn't above zero. So the volume up down was down. Okay, so the flows in stocks, the volume flows in stocks was actually negative. Okay, we saw the ad here, the advanced decline was actually in negative territory as well. Now it did rise throughout the whole day, but it was in negative territory. Okay, we see the VOLD was in negative territory, and we see the cumulative build on the tick here was also in negative territory. And so we have three out of basically all three of them, all right, all three of our market internal measurements here were all in negative territory on Friday, even though we had a massive move to the upside on Friday. So that is, another potential warning sign for me. And really, the reason I think that is because we have to remember, right? There's the Magnificent Seven. And, we saw some tremendous earnings from companies like Amazon, companies like Meta, and really much of the rally was fueled by the Magnificent Seven stocks on Friday. And as a result of that, we see that the other stocks were not actually very bullish. And, as a whole on the market structure, it was not a bullish day. But those Magnificent Seven stocks are weighted so much that it actually carried the performance of the entire market on its back. And we saw a very bullish day on Friday in terms of, the SPY, the S&P 500, or the SPX. Okay. And that brings me to the next point, that it's not all completely bearish, right? I've got a risk on ETF right here that consists of copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. And, while it is in a downtrend right here, we just want to focus on what it's recently been doing. And it's recently been ticking up as the market has been ticking up. We see our risk off ETF right here, which is going to be comprised of gold, US Treasury bonds, the yen, utilities, and staples. It did tick down last week, right? So we saw an uptick the past 2 weeks here. We saw a downtick here in risk off. So the market is still shifting a little bit more towards risk on, more recently. Okay. And then we've got the actual market down here on the bottom. So this is going to be your S&P 500. But yet again, what do we have? Well, we've got a negative divergence here, right? Where the stock market's making new highs, but this is making lower highs here. And, if we were to look at it from this point, the risk off ETF is actually in an uptrend right here, while this is starting a little bit of a downtrend. So, it's not completely bearish. Everything's not completely bearish. We're seeing a little bit of, risk on trading, but, there's lots and lots of warning signs that we're seeing across the market. Now, if we take a look at these four stocks, okay, we've got, and these are going to be sectors, basically. We got semiconductors, home builders, broker dealers, and industrials. We can't be bearish on the market or scream that, we're going to go into a bear market if all four of these are above their previous highs. And so, what does that mean, right? Why is that important? Well, it means that we've got higher low territory. If we were to pull back and retest these levels, that's higher low territory, right? Low, higher low, right? Low, higher low, low, higher low, low, higher low. You get the point. So, even though we're seeing warning signs that maybe the market's trying to top out soon, or that, we're going to get some type of pullback or correction, it doesn't mean that the market's about to completely roll over and that we're about to drop 20%, right? So you want to keep things into perspective. Okay. And so all four of these have room to pull back and be in that higher low territory. If we take a look over here as well, we're seeing the exact same thing. Okay. We're seeing that, all of these have broken out. And if they were to pull back, all right, to their previous highs, yet again, that is area for higher low territory, right? For higher low territory. So, that's what I'll be looking for. If a lot of these warning signs do play out and we do see some corrections, I'm going to come and I'm going to look at these charts. All right. I'm going to come over here and I'm going to take a look at these charts and I'm going to say, are these charts still above their prior highs? Are they retesting their prior highs? And are they going to be able to hold those prior highs? If so, then, we're still going to be generally bullish on stocks for the year. I dropped a really, really amazing video here recently, just going over all the historical data that suggests that we basically have about an 80 to 90% chance of the stock market ending higher this year, anywhere from about 10 to potentially even 20% gains on the year. And that's just what the numbers say. So it's a really detailed video, just like this one, but it's all data sets rather than charts. Now, this is more along the line of some things saying that, hey, it's not completely bearish, right? And what we're looking at is the performance of growth versus value. All right. So we've got the IWO by IWN ratio chart here. And we've also got the SPY G versus SPY V. So this is basically growth versus value in the middle, growth versus value in the bottom, different ways to measure growth versus value. All right. And what do we see? Well, we see growth is still outperforming value here over the past 3 months or so. It really just for the entire month of January, right? This is the beginning of January right here, right? And what do we see? Well, we see the SPX, the stock market continuing to make new highs. We see growth versus value outperforming on this ratio and growth versus value outperforming on this ratio here as well. So, again, I didn't want to come off overly bearish in this video and make it seem like, there's a disaster coming in the market. There's just lots of warning signs, right? And we're seeing a lot of things underneath the hood that I want you guys to be aware of. Another thing we're seeing is the relationship between Treasury yields and the S&P 500. They typically move opposite of each other. Okay, so what we've got in here is actually an inverted 10-year treasury yield in white, meaning that whatever the white chart is doing is the opposite of what the 10-year treasury yield does. So if the white line on the chart is going down, that means that the 10-year treasury yield is actually going up. Okay, that's what inverted is. And so you can see that the inverted treasury yield follows the orange line very well. That's going to be your S&P 500, by the way. And we're at this moment now where we're starting to diverge, okay, where they're not moving. Look at this huge move to the upside we have in the stock market, and then look at this huge move to the downside we have in our inverted 10-year treasury yield. Now, whenever these two diverge from each other, okay, and they're not trading in sync, it generally tends to be bullish for stocks. Okay, so this is this period here we had in about April to basically the summer before the stock market topped out last year in 2023, we saw this period here where treasury yields were actually going up, okay, meaning that the inverted yield chart was going down while the stock market was going up. And again, this benefited stocks actually. And we're seeing the start of that right now, again, where they're going to be this divergent period and they're performing opposite of each other. So, you know, we're looking at this and we're saying, well, historically, most recently in history, this was a bullish thing for equities. So we'll see if that will continue, or maybe it could be something different, right? So let's dive in a little bit deeper. And when we take a look at our smart money versus dumb money index, and smart money, people often will refer to as HYG. This is your high yield ETF. And then dumb money, obviously going to be, investors in the stock market. And we are seeing a bearish divergence here where we're making lower highs, but the stock market's making higher highs. So maybe quote unquote smart money knows something that we don't. Okay, if you also use TLT as a leading indicator, for the stock market, which I've done for a while, and it's led to plenty of times where it's been a nice warning sign and an indicator of potential things to come in the market. You see over here when we're making lower highs in the TLT, but we're making higher highs in the stock market, it suggests that the stock market is due for a correction if TLT is going to be a leading indicator. And sure enough, we got that pullback. Same thing over here, making lower highs, but higher highs on the stock market suggests that the stock market should pull back. And we've seen this play out countless times again. And what do we have right now? Well, we have lower highs in the TLT, higher highs in the stock market. If TLT is going to be a leading indicator, it suggests that at some point, the stock market could be due for a pullback. Now, keep in mind that these divergences can last for longer periods of time, okay? This one right here was a few months, right? This one right here was about 2 months. And this one's only been about 1 month so far. So these divergences may continue, right? TLT could, in fact, continue to make lower highs here, and the stock market could continue, in fact, to make higher highs, or we could see this correct, right? And we could see a turnaround in TLT where it starts to make higher highs and then goes back in line with the S&P 500. But at the moment, this is yet again another one of those warning signs that you guys want to pay attention to and be cautious of. Right here, we've got the Magnificent Seven on the top, performance of the Magnificent Seven, and then we've got the performance of the other 493 stocks in the stock market. And oftentimes, whenever these diverge from each other, it's not as easy to tell which one is going to get the pullback and what's going to happen necessarily. But oftentimes one of them follows each other. And this is just a really great example. This is a daily time frame. So this tick up right here that you see, this was what I meant earlier when I said on the market internals chart that, we saw negative outflows in the market. We were in, negative outflow territory in the VOLD, in the add, and in the tick. But the stock market actually had a really bullish day. And because of that, and the only reason because of that was because of the performance of the Mag 7. The Mag 7 absolutely skyrocketed on Friday. But when you take a look at the other 493, they plummeted. So we're seeing this divergence here now where we're making lower highs in the other 493, but higher highs here in the Mag 7. Again, this could be another warning sign for the market, right? We have this period here where we started to get a divergence. And then what did we see? Well, we saw the Mag 7 start to roll over. If the Mag 7 are rolling over, then it's very likely that the broad market indexes are rolling over as well. And this is going to be the skew here. This is going to be your skew index. And so this generally will move with the stock market. Okay, meaning that if you see the skew going up, you're going to see the stock market going up. But there are these levels where we do often tend to see some type of tops, right? We've got 154.45 right here, right? And you can see that that ended up being a top, and then we started a pullback. We've got 146.5 over here. We hit that level. Over here, we hit that level. We started to see a pullback. We came back in between those levels last summer, right? And then last summer, we started to get a pullback. And you can see here, we're actually above that 154.45. And, these are levels where we generally start to see some type of a top start to build in the market. Now, it doesn't mean it's a forever top that we can't break. No, but it doesn't mean that, we see a little bit of a short-term top and then start to see a pullback. Yes. And so, again, just another one of those things that we're seeing as a warning sign. And so if the skew is going to continue to go higher, most likely that's going to involve the stock market continuing to go higher. But once this starts to roll over, it could be a sign that the stock market is also about to roll over, or that the stock market is already currently rolling over with it. So pay attention to the skew index here as well. And last but not least, we've got the percentage of stocks trading above their 200-day moving average and their 50-day moving average. So the 50-day moving average is going to be on the bottom here, and the 200-day moving average is going to be on the blue here. And what do we see? Well, guess again, guys. All right, can you guess? That's right. Negative divergence, bearish divergence. We're making lower highs, while the stock market's making higher highs. I've highlighted for you guys many of the prior divergences. Okay, you take a look here, making higher highs, but the percentage of stocks above their 50-day moving average is making lower highs. And what do we see? Well, we see a stock market pullback. Okay, same thing over here. Higher highs, we're making lower highs on the percentage of stocks above their 200-day moving average, lower highs on the percentage of stocks above their 50-day moving average. And what does the stock market do? Well, the stock market pulls back afterwards. So lots of bearish divergences, lots of negative divergences underneath the hood of the market that you really can't tell or see if you don't know what to look for. These aren't things that people commonly share or things that people commonly put out. And most of the time you just see people saying, oh, if stocks went up, saying, hey, we're bullish. If stocks go down, saying, hey, we're bearish. And they don't really provide much insight into what could potentially happen in the future. So just trying to do that in today's video and provide a little bit of value to you guys. Hopefully y'all enjoyed it. If you did, smash that like button, subscribe to the channel. Don't forget to subscribe and sign up for the Discord. So in the Discord, January 13th, we're talking about DraftKings. It's got a 100% win rate in February. Just so you know, February has started, which is one of the reasons that we're looking at it, is that it's been green every single February. And when I zoomed in on the daily time frame, I said, hey, well, you know what? We've got a nice falling wedge here. Wave E of the falling wedge was a perfect 50% retracement of the D wave up. That's a very bullish sign right there. And the stock ended up rallying about 21% in just a few days. That's one of the over 20 plus swing trade ideas that I give out in the Discord every week. So you can sign up for that using just $10 a month. Link is in the description. You can see screenshots of, some of the different profits of the different plays that we've been in. The Discord is growing. It's growing nicely. It's a really good community. It's been around for about 3 months now, and looking forward to seeing you guys in there, hopefully, and it continuing to grow. If you don't want to pay, remember, I've got the completely free newsletter. All right, and you can sign up for that and get those directly to your inbox every single week.